We are here with the co-CIO of Bridgewater, Bob Prince, and there has been a lot of discussion here and optimism that we're out of the woods, that we've gone past the worst, just as they were talking about, and yet you say that we really haven't seen the bulk of the tightening that's already happening. Where do you expect will get hit most and hardest in the next coming months from the tightening that the Fed has already done?
Well, we're still in the middle of a long process. You know, if you go back to 2020, you had printing of money, the fiscal pipes basically distributed it to everybody. They spend it. We went from what could have been a deflationary depression to an overshoot in the other side. And so that produced what we would call a monetary inflation. And that monetary inflation is now self-reinforcing as one person's spending produces income, which produces spending. And so we had the inflation, then we have the tightening, and then what comes next is the decline in growth. If you don't get the decline in growth, you have to get more tightening. If you do get the decline in growth, it's very likely that you get a pause by the central banks. A pause is going to trigger a rally in the markets. The rally in the markets is going to help the economy, and that downtrend in inflation may just be stopped at that point. You might have to do it again. So it's very hard to say whether we're done with the tightening or we're going to have another tightening. But what we can say is that the next shoe to drop is a decline. It has to be a decline in the economy, and in particular, a contraction in labor markets, because the core issue with inflation is wages. Wages are running too high to have a 2% inflation rate, and the way you get wages down is you change the supply-demand dynamics for labor.
At the same time, corporations need more workers than they have right now. If anything, what we're seeing in the United States is the reverse of that. They're saying we want more workers. In fact, look at the JOLTS numbers, they're really disturbing. So where is that disruption in the labor market going to come from? That
reflects the problem. Because if corporate profits are okay, you don't lay off workers. And if you don't lay off workers, you don't raise the unemployment rate. And if you don't raise the unemployment rate, you don't bring down wage inflation. And if you don't bring down wage inflation, you don't bring down inflation sustainably. So one of the metrics that we look at to know whether there's been enough tightening is whether we've actually had a decline in earnings. We think you probably need a 20% decline in earnings to get enough of an inducement to lay off of enough workers to push the unemployment rate up enough to bring down wages, to bring down inflation. So that's the next shoe to drop.
So we're not seeing that, though. When you talk to executives, they're talking about investing. They're talking about still hiring people. You see that in the data as well. Yes, it's been weakening,
right,
but you're not seeing that scenario. So if that doesn't happen, does that mean a 6% Fed funds rate? I mean, basically, what is the sort of counter push that leads to that 20% decline?
The reason it's not happening is because they have demand. There's still a lot of nominal demand. You and I were just talking earlier about the factory, right? They can't build enough cars, so to meet the demand, because there's a lot of demand. So, but the money that was printed, we're experiencing the after effects of the monetary stimulation of the U.S. and the European economies, and now the money is spinning around the system. It's just exchanging hands from one to the next, and one person's income, they just spend it, and so spending has really not fallen off hardly at all, not nearly enough to bring down inflation.
Well, and that's my question, Bob. Is it spinning around slower at all? Because it was thought that a lot of individuals, households had a lot of money in their balance sheets because so many have been giving them, fiscal and monetary to some extent. Is that coming down? Can you predict a point where it does come down to have some of the realignment you're describing?
So one of the things that we do is that we go all the way down into the accounting of GDP. Like we go down into where did you get the money, what did you spend it on, where did that go, and we track it all the way through. And you're right that there was a lot of money printed and put in people's bank accounts. And when the government's fiscal stimulation rolled off, you didn't get a contraction in spending because people pulled the money out of the bank account and they kept maintaining their level of spending. But that's not now happening anymore. What's happening when you go do the accounting is that spending is being financed by income, which is being financed by spending. And that produces a self-sustaining process. And the way you break that process is that you reduce income. And the way you reduce income is layoffs. And the way you get layoffs is companies have to experience some pain.
Which they're not quite doing
Not
yet.
at all, not nearly.
As an investor, this is a unique moment. You talked about a couple years back, the end of the boom-bust cycle. Now this is the return of the boom-bust cycle. Are we in the boom or are we in the bust?
It is the return of the boom-bust cycle. But I think that's really important to register because for a decade or more, there was the Fed put, there was a certain mentality in the markets that there's really not a lot of upside, not a lot of downside to the economy. It's pretty stable. And now it's just going to, and that's actually what's priced in right now. What's discounted is actually a return to the last decade, but what's actually happening is more like the 70s, more like the boom-bust cycle. And so it's unlikely that we have kind of a one-and-done, painless, tightening, lower drift to inflation down to the target and then happy days again. That's unlikely. It's probably going to be an iterative process over actually a number of years.
One of the things we certainly saw, because of all the stimulus you talk about, is an increase in asset values. Some people talked about a possible bubble, actually, in asset values. Do we know where we are on taking the air out of that bubble? For this reason, there's a lot more money now behind closed doors than there was before the great financial crisis. There are a lot more prices that were discoverable there. There's not as much to marketing.
There are different forms of bubbles out there, and some of them have been popped. The most obvious bubbles have been popped. The companies, the tech companies that don't have any earnings for years to come. But there's an earnings bubble. There's a profits bubble out there that's still in place that's priced in to be not a bubble. It's going to continue. And that profits bubble was inflated by the printing of money. Because in the initial stages of the printing of money, one person's spending is somebody else's income. In the initial stages, that income was corporate income, corporate profits, and putting people back to work. And that raised the level of earnings, but we're not there anymore. But the markets are still being priced off that level of earnings. We don't think that's the steady state.
So what kind of decline are you talking about? What kind of sell-off to right-size markets, stock markets in particular, with that earnings bubble?
Well, if you had a 20% decline in earnings, that would actually be pretty normal. That's historically what there's never been a rise in the unemployment rate of a substantial amount without a decline in earnings since 1960. And to get a 2 or 3% rise in the unemployment rate, historically, you need about a 20% drop in earnings. So if you get a 20% drop of earnings, that's not the end of the world in terms of earnings. You're basically on trend or just a little below trend, but you're back to a 22 PE on the equity market, with bond yields much higher than where they were last time we were 22.
So what kind of sell-off would that be? Like what, if you give like a percent?
Equal to the earnings,
yeah,
roughly.
20%
Equal to the earnings, probably maybe even two stages. One for the earnings, one for the to reset the yields.
So a lot of what we're talking about here is the model that we're used to over a period of generations, actually, about the way it works, monetary and fiscal. Are there some factors that might change the models? Particularly as we're here in Davos, people talk about longer-term issues. Climate, big issue that hasn't been around forever. Demographic trends around the world are troubling. Globalization, the thrill seems to be coming out of globalization, as it were. Are there factors that could change the entire cycle?
Well, there are some of these trends that are actually more problematic for inflation. Less immigration, less globalization, and I think one of the interesting things on this cycle, those are kind of longer-term pressures. If China bounces back, that's we look at inflation as wages and everything else. Everything else is down, partly because China was in a recession. If China comes back, everything else is back where it was. So, but one of the interesting things about this recession, or not, we're not in it yet, I guess, this tightening cycle, is that at the beginning of 2022, the tightening got priced in before the Fed made one move. Right? It's never happened that way before. And what you see now is that everybody expects a recession. What was it, the CEO survey, that 98% of CEOs expect a recession? It never happened that way. Everybody's blindsided. So the thing I wonder about is if everybody expects a recession, do they take the actions that, it doesn't happen and so on and so forth? But anyway, that's speculation.
Well, but it raises a question.
But that's a little different, right? I've never remembered one of those.
Right. It raises a question about what the Fed does with this? Because you see right now bond yields going down. A lot of people are expecting them to go much further lower by the end of the year because there's still a lot of money. Do you think that this is sort of counterproductive and it's going to have to be yields go higher? Or have we seen peak yields? Have we seen this sort of top end?
Well, it sounds to me like the Fed is trying to talk the markets out of it, but for good reason, because the typical cycle in a tightening cycle would be they tighten, and then you get a downturn, you get a trend down in inflation, and then they pause. Well, when they pause, the markets rally. When the markets rally, it stimulates the economy, and the inflation never comes down, and then you got to do it again. So they really don't want the rally and related to a pause, but it's tough because it takes months and maybe years to see. It takes probably 12 months to see the tightening flow through to growth. It takes probably another 12 months to see what it does to inflation. So you're making decisions today based on what you think conditions will be 12 to 18, 24 months from now, and therefore it's tough. It's tough to, but if you take two different cases, going back to the 70s, Germany did the one and done. Early 70s, they put the hammer down. They peaked the spending in the early 70s. They peaked the bond yield in the early 70s, stabilized currency, and so forth. Every other country had 3 cycles: tightening, easing, tightening, easing, tightening, and they didn't peak the bond yield to the late 70s. So it could go either way. It really comes down to the choices that are made by the central banks as to whether it's kind of more pain now or drawn out over time and multiple cycles over time. But back to your boom-bust question, we've been in a boom. We've been in a boom, and that boom led to a tightening. Probably a bust is what comes next. But it all depends on how aggressive the moves are, even from this point forward.
Bob Prince, thank you so much. Wish we had more time. Bob Prince of Bridgewater, thank you so much. Back to you, Alex.